Hello, this is Brenton Harrison with Ultra Borrowers Academy, an online course where we help people with a mountain of student loans take back control of their debt on their path to a better financial future. I want to have another video for you today on the revised pay-as-you-earn plan. So in a previous video, we talked about the two different types of plans, income-based repayment and pay-as-you-earn, that allow you as a married couple to avoid having both spouses' income included in the calculation for your payment if you take the steps to make sure that you file your taxes married filing separately. Well, today, what we wanted to do in this video is we wanted to give you some information on the third most popular plan, or I should not say in terms of 1, 2, and 3, but just of the three most popular income-driven plans. The revised pay-as-you-earn plan is a plan that does not give you that opportunity to file your taxes separately, but it is a good plan for people who either both have student loans or people whose incomes line up so that it doesn't benefit them to file their taxes separately. So what I wanted to show you today is how the revised pay-as-you-earn plan works for married couples who both have federal student loans that are being paid back using this plan. So let's get into it. All right, as a recap, for repetition's sake and driving these points home, we always start with a recap of what income-driven plans are and how they work in the first place. Income-driven plans are plans whose payment has no connection to your student loan balance. Instead, it's all based on a percentage of your discretionary income. The discretionary income calculation is a formula that's used to take your household pay and subtract 150% of what's called the federal poverty level. And when you do that calculation, at the end, you get your discretionary income. And depending on the plan which you've chosen, you pay either 10 or 15% of that each year towards your student loans. Now, in the previous video where we talked about the two other plans, the goal of filing your taxes married filing separately was so that when you did this discretionary income calculation, only the person who was paying back their loans using this plan would have their income included in the calculation, as opposed to their income and that of their spouses. We talked about those two plans, income-based repayment and pay-as-you-earn, that have that married filing separately exclusion. But today we're talking about the revised pay-as-you-earn plan, because the revised pay-as-you-earn plan does not have that same exclusion. Under this plan, no matter how you file your taxes, you will still have both incomes included in that payment calculation because it doesn't have the allowance that you find in the other plans. So how does it work if both of us have student loans, we both have decided to pay them back under an income-driven plan, and the plan that we've chosen is the revised pay-as-you-earn plan? Well, I'll show you how. As I said, this plan is ideal when both spouses have substantial student loan debt and it's not benefiting them to file married filing separately. And when you have this plan where both of you have chosen repay, here's what happens. They take your loans and they put all of your household loans, yours and your spouse's, in this metaphorical pot. So you're never going to have your loans in the actual same place, but in terms of calculating your payment, what they first do is they take all of your loans, they put them in one big pot, and they look at your household income and they determine how much you should be paying as a household first. So the first step, they don't take your loans separately, they put them all in one big pot and they figure out, based on the payment information we have from these two people, how much should they be paying in totality as a household. After they've done that, to determine that total household payment, they then break up what amount goes to each person's loan based on the percentage that you contributed to the pot. For example, if my loans are 60% of what goes in the pot with me and my wife, then hers would be 40% of the pot. And any payment that we make, 60% of the money would go to my loans and 40% would go to her loans. I'll show you a quick example. Let's say that we have a household where the adjusted gross income, which is one of the ways that you can put money into the formula for the discretionary income, their adjusted gross income is $200,000 as a household. Now, of the $200,000 income that they have, both of them have a significant amount of student loans. In this case, the husband has $100,000 in student loans, and the wife has $300,000 of student loans. So if you break that down into percentages, the husband has 25% of the total that are his loans, and the wife has 75% of the total that represents her loans. When they put it all in that one big pot, That's how the percentage breaks down between the two. Remember, the first step is determining how much they should pay as a household. So, under the revised pay as you earn plan, we took their $200,000 adjusted gross income. We subtracted 1.5 times the federal poverty line for a family of two. And it leaves them with a discretionary income as a household of $174,635. Under the revised pay as you earn plan, you pay 10% of that discretionary income each year, which leaves them with a discretionary income payment of $17,464 for the year and $1,455 for the month. This is, in totality, what they will pay towards their loans as a household. Now, the next step is to break that amount, that household payment, down based on the percentages that each of them contributed to the total loan balance. And when you do that, take that $1,455, and the husband is going to have to pay 25% of that payment towards his loans, while the wife has 75% of that payment going towards hers. In this example, that means that his loan payment is $363.75 or 75 cents a month, and hers would be $1,091.25, 75% of the total student loan balance. Now, I hope this was helpful for you in terms of understanding when both of you have student loan debt under the revised pay as you earn plan, how that payment is calculated, and how the amounts that go towards your loans are determined. There's a lot of details about these income-driven plans. That's why we break them into smaller chunks with these videos so that we can go concept by concept and build your knowledge so that every single year when it comes time to recertify your income, or if you're just picking your payment plan for the first time, that you have a better idea of where to start. Again, my name is Brenton Harrison with Ultra Borrowers Academy. If you'd like to hear more about our site, about our course, you can go to ultraborrowers.com. And if you like these videos, I encourage you to not only subscribe and like these videos, but also to set the notifications so that you're alerted when we drop new information for you. I'll see you then. Bye.